Now we cross over to our Hanyang for global insight and an in-depth look at important developments in world affairs.
Thanks very much, Mark. The global economy is expected to grow at a lower rate than expected. That's the issue that we are covering today. The World Bank's latest forecast put the world's GDP growth at 4.1% in 2022, down 0.2 percentage points from its previous projection. And it says that growth prospects have been clouded by various downside risks, citing renewed COVID-19 outbreaks due to the new virus variants, continued inflationary pressure, as well as financial stress for many governments that are hitting record debt levels. We discussed what's ahead with Yeol, Associate Professor of Finance at Hanyang University, and Mohammed Ali Nasir, Associate Professor in Economics at the University of Huddersfield and author of Off the Target, The Stagnating Political Economy of Europe and Post-Pandemic Recovery. Very warm welcome to you both. Thank you so much for joining us today.
Thank you very much.
And well, let's start with you, Professor O. Now, according to the World Bank's 2022 Outlook report, the global economic growth is expected to face a slowdown for the next 2 years. And it seems that the world's two largest economies, the United States and China, of course, they might experience a sharper than expected deceleration. Would you agree with that view?
Yes, I would probably mostly agree with this view, but there's the mechanical side to that and there's the non-mechanical side. So the mechanical side is that because of COVID and everything, the global economic growth actually contracted by over 3% in 2020. So starting from a low base, 2021 growth was always going to be faster. But there are still a lot of uncertainties and reasons to expect this slowdown. So no one back in 2020 expected the pandemic to last this long, 2 years in. And prolonged pandemic, new variants, Delta was been and gone, Omicron, they've put more than everything downward pressure on labor market participation. So we are seeing a lot of missed work because of illness, absenteeism, and that's causing all these supply chain issues and inflation. And added to the fact that places like China are still clinging on to their zero COVID policy. So the fact that all these sort of pandemic-related uncertainties are there, and adding to that, the fact that the accessibility to vaccines have been very uneven across developed and emerging world, and also with the fiscal stimulus and fiscal capacity and everything, it means that there are a lot of reasons for growth to be A, uncertain, and B, see a lot of downside risks there. Will there be a new variant? How serious will this inflation threat be 12 months down the line? So while the projections appear reasonable, there's a lot of different things that can push the economic growth either up or certainly down as well.
Right, quite a number of economic uncertainties there. And on top of that, some geopolitical complexities, it seems. Professor Nasir, you predicted that the US-China trade war would continue throughout 2022. How do you think this is going to affect global trade?
Yeah, I mean, the US-China trade war, as we know, it was started by Mr. Trump. And it was an interesting war of its kind, which was announced on Twitter, which was the favorite platform and mode of communication of Mr. Trump. But from very beginning, it wasn't a matter between US and China. A lot of other countries, they got affected by the trade tension between US and China, and that included some of the closest US allies, including EU, Canada, and even South Korea. So any country which was running a decent trade surplus against US had to face the wrath of Washington. But if we look at how it unfolded to over 2018 and 2019, the US trade deficit, beside the trade war, actually widened very significantly. And one of the explanation could be the transshipment. When you face with the trade restrictions, you go around them, and that was the case in the case of the US-China trade war. And I mean, you can look at the exports from the other countries, for instance, from Vietnam. Overnight, they skyrocketed and they went through the roof due to the US-China trade tensions. Following from that, in early 2020, we had what we called US-China trade deal phase 1. And according to that deal, which came into effect on 14th of February, on Valentine's Day, I think they couldn't find a more romantic day, the China committed to purchases of about 200 billion US dollar of goods and services from US for the next 2 years period. But now we got the figures, we can see that that target was missed by a significant margin. So now there is, as it stands, there is no phase 2 trade deal between US and China. And there's a new administration in office under Mr. Biden. And Mr. Biden would not like to give an impression of being a soft touch man or somebody which is a soft corner for China. And as we, if you may remember that in the March last year, in a very high top official meeting top diplomat meeting between China and US, there was a public clash between the American and Chinese diplomats. And if we look at the economic side of that, as it stands, we got the last, according to the most recent figures on trade, US was running 15 years high trade deficit in the third quarter of 2021. And the projection is that in the fourth quarter, there will still be a very large trade deficit, which would be more than 200 billion US dollar. So there's an economic side and there's a political side to it. So putting these two factors together, I think Mr. Biden and Biden administration would be in a difficult position to give China any question here, and probably at least they will try to make sure that there's a continued pressure on China. There's some sort of continuity of phase 1 trade deal, and probably they will demand China to do more and do better than what they've been doing in the last 2 years.
G2 economic conflict, which is ongoing, of course. And Professor O, another large part of the new World Bank report, it was on asset purchasing programs around the world. And the World Bank says that these have largely worked in addressing the sort of financial distress and the recovery that we needed to see. But then the report also suggests that countries need to start winding down these asset purchasing programs. It says that macroeconomic vulnerabilities have been created by these very ultra-loose monetary policies. Would you agree with that view? When do you think is the right time to start reducing the balance sheets?
So that's not an easy question by any means. What we have to remember is that COVID-19 was a completely unprecedented thing. So going back to March 2020, the bond market was very nervous. We saw a huge sell-off in treasury bonds that we haven't seen the likes of ever, really. So central banks didn't really have much choice when it came to asset repurchases. They had to do that. So they had to resort to a very unconventional means. So Fed, for example, ended up buying corporate bonds directly for the first time in their history. But all of these had their own unintended consequences, which is asset side, asset inflation. So the prices of stocks and bonds have been skyrocketing over the past year and a bit. And it hasn't helped the fact that companies using this Fed money, ultimately, a lot of them ended up engaging in stock buybacks and refinancing their bonds early rather than engaging in new investments. So that, to an extent, I would say, contributed to all these bottlenecks and supply side as well. But what is definitely indisputable is that asset inflation have been the sort of unintended consequence of this cheap money. But I'm not sure how much of that is to really blame for inflation that's going on at the moment. QE has been going around for a decade now. And is it really down to cheap money, or is it really down to the fiscal side stimulus that we saw? Well, added to the complication is the fact that interest rates and monetary policies are generally not a great tool for addressing supply side induced inflation. They're good when, inflation comes from fuel demand. But this is really a supply side thing, like, bottlenecks at ports, workers not reporting in. So monetary tightening could have its own issues, actually. So they run the risk of prolonging recession, which then can actually result in yet another fiscal stimulus and actually making the worse. So it has to be winded down. I agree with that, but the speed is of ultimate importance. And there's as much of a risk overreacting as well as underreacting.
And Professor Oh, in the US where you are, President Joe Biden is expected to appoint new officials to the Fed, including Sarah Bloom Ruskin, Lisa Cook and Philip Jefferson. They're expected to be appointed as the new governors, particularly with Ms. Ruskin. Where do you think they stand on monetary policy, and what kind of views do you think they're going to bring to the board?
Right. So the reporting here concentrated on the fact that, that's a diversity and more inclusive appointment. Lisa Cook and Philip Jefferson, both of African-American descent. They're trying to make the board look closer to the population as a whole. But I think there's a lot to, expect in terms of the policy dimension too. So especially with Sarah Bloom Ruskin, she knows a great deal about regulatory reforms. We had a whole bunch of reforms that were implemented since the financial crisis of 08-09. Designed to curb financial institutions from taking excessive risks. Those that came to known as Volcker rules, part of the Dodd-Frank Act. Well, many of them got, I would say, a little loosened during the early part of the Trump administration. And Raskin is definitely expected to strengthen these rules. So it's a fine-tuning here and there, but it's actually quite a big deal for the banks. So one of the priorities that she's expected to sort of push forward is tightening some of the loopholes in stress testing requirements. Since the financial crisis, banks are supposed to perform stress tests, and if they are seen as fragile, they have to hold more capital. And there's some of the sort of like relaxing of the rules. They are supposed to be rolling back towards where it were, going back to the Dodd-Frank baseline. And I'm not sure whether this will go ahead or not, but Sarah Bloom Ruskin has held a strong view on climate-related exposure. So, for example, if you're a bank lending to large oil and gas companies that are creating more climate risks and risks to your overall portfolio, there are certain quarters in the sort of academic and policy sphere where whether that should be met with greater capital requirement because you're bringing in more risks to your portfolio. And that could be a source of controversy further down the line. But it is expected to have a material change in how the board conducts, especially on the regulatory side of things.
I see. And Professor Nasir, now many low-income developing countries are facing unsustainable external debt burdens amid these sharp interest rate rises that we're seeing. And well, how will they be affected by the unwinding of asset purchasing programs, and what should really be done to help stabilize their situation?
Yeah, it's a good question. I think, since the start of the pandemic, there's been a sharp increase in the indebtedness of the developing and developed economies, and both the private and public sector. There is increase in leveraging, and now there are inflationary pressures on the central banks, specifically in the developed economies. Although so far most of the central bank they've been avoiding the temptation, and they hold their line so far. And there was a view held by the Fed and by ECB that this inflation is transitory. And I think I agree to that there've been supply side issues, and if you do monetary contraction, they're not going to help. And it is just mere common sense that when you are going to have a very sharp recovery, you are going to have inflation overshooting your targets. So in that climate, if the central banks, particularly the big players like Fed, ECB, Bank of Japan, or Bank of England, if they do unwinding, as it stands, they are holding assets of over 25 trillion US dollar. And so that is really an elephant in the room. And if they do unwinding in the current climate, where the global outlook of the global economy's outlook is, it shows that there are weaknesses and there are a lot of uncertainty. And it's not only the World Bank, which has revised its forecast, but IMF had its forecast in October 2021, and now they are going to downgrade that end of this month. And similarly, the OECD forecast later than IMF in December, there was a downgrade from the IMF's forecast in October. So the global economic outlook that suggests that there shouldn't be monetary tightening by these big players or unwinding of the monetary stimulus. Fed has started tempering it started to move toward tempering and reduce the rate of asset purchases, and it is expected that there'll be an asset purchases of about 40 billion in the next 4 weeks or so. ECB has continued asset purchases so far, and but in any way, unwinding the quantitative easing or asset purchase which is being carried out over the last few years won't be wise. And I think considering the fact that the inflation is due to mostly supply side issues and some rebounds in the recovery and economic activity, in the current climate, it won't be wise to withdraw the monetary stimulus. And definitely, if that happens, they're going to pose a lot of challenges to the developing economies. We could expect depreciation of their currencies, flight of capital, and a strong dollar. And I would say that in the current climate, a strong dollar or expensive dollar would be too expensive for the global economy to afford. So therefore, the developed countries' central bank must avoid that temptation and hold their line for a bit longer, particularly I would say in 2020 at least.
I see. And well, I'm afraid we're out of time today, so this is where we'll have to end the interview. That was Chiyo Jimio, Associate Professor of Finance at Hanyang University, and Mohammed Ali Nasir, Author and Associate Professor in Economics at the University of Huddersfield. Thank you both so much for your insights today.
Thank you very much.